working capital ratio, quick ratio, earnings per share or EPS, price to earnings ratio, debt to equity ratio, and return on equity. There we have it, the top 6 financial ratios that will be discussed in this video. I'm sure you have heard about some of these financial ratios before, and even if you have not, you are hearing about them now, which is right on time. In today's easily comprehensible video, you will learn all the basics about these few crucial financial ratios. So without further ado, my name is Daniel, and welcome to the GreenWave. In finance and the investment world, fundamental analysis relies on data from financial statements to compute various ratios. Fundamental analysis is used to determine a stock's intrinsic or true value so that it can be compared with its market value. There are 6 basic ratios that are often used to pick stocks for investment portfolios, which have already been outlined in the intro. Most ratios are best used in combination with others rather than in isolation for a more comprehensive picture of company financial health. To begin with, assessing the health of a company in which you want to invest your hard-earned cash involves measuring its liquidity. Liquidity refers to how easily a company can turn its assets into cash to pay its short-term obligations or short-term debts. The working capital ratio or the current ratio can be useful in helping you measure liquidity. Working capital is the difference between a firm's current assets, what the company owns, and current liabilities, what the company owes. Importantly, the word current in this case means that the belongings are able to be used within 1 year, or the debts need to be repaid within 1 year. This ratio represents a company's ability to pay its current liabilities with its current assets. The working capital ratio is calculated by dividing current assets by current liabilities. For instance, let's say that company X has current assets of $8 million and current liabilities of $4 million. The working capital ratio is 2 because 8 million divided by 4 million equals 2. That would be an indication of healthy short-term liquidity. However, if 2 similar companies each had ratios of 2, but one had more cash among its current assets, that firm would be able to pay off its debts more quickly than the other. A working capital ratio of 1 can imply that a company may have liquidity troubles and not be able to pay its short-term liabilities or debts. However, the trouble could be temporary and later improve. Whereas a working capital of 2 or higher can indicate healthy liquidity and the ability to pay its short-term liabilities. On the other hand, it could also point to a company that has too much in short-term assets, so for example cash, some of which could be better used to invest in the company or pay shareholder dividends. Secondly, the quick ratio, also called the asset test, is another measure of liquidity. It represents a company's ability to pay current liabilities, so short-term debts and obligation, with assets that can be converted to cash quickly. The calculation for the quick ratio is current assets minus inventory, so stocks, divided by current liabilities. The formula removes inventory because it can take some time to sell and convert inventory into liquid assets. So again, if company X has $8 million in current assets, $2 million in inventory, and $4 million in current liabilities, that means that the quick ratio would be 1.5 because $8 million minus $2 million equals $6 million, and if we divide $6 million by $4 million, we get 1.5. This indicates that the company has enough money to pay its bills and continue operating. A quick ratio of less than 1 can indicate that there isn't enough in liquid assets to pay short-term liabilities. The company may have to raise capital or take other actions. On the other hand, this may be a temporary situation. Ratio number 3. When buying a stock, you choose to participate in the future earnings or the risk of loss of the company. Earnings per share, or EPS, is a measure of the profitability of said company. Investors use it to gain an understanding of company value. The company's analysts calculate EPS by dividing net income by the weighted average number of common shares outstanding during the year. So the 2 important variables here are the net income of the company and the number of shares outstanding. If a company has 0 or negative earnings, i.e. a loss, then earnings per share will also be 0 or negative. And in general, higher EPS indicates greater value. Moving on, we have the price to earnings ratio, called PE for short. This is used by investors to determine a stock's potential for growth. It essentially reflects how much you are paying to receive $1 of earnings. It's often used to compare the potential value of a selection of stocks. To calculate the PE ratio, we divide the company's current stock price by earnings per share. If, for example, A company closed trading at $46.51 per share, and the EPS for the past 12 months averaged $4.90 per share, then the PE ratio would be 9.49. Therefore, investors would spend $9.49 for every generated dollar of annual earnings. Investors have been and often are willing to pay more than 20, 30, or even 50 times the EPS for certain stocks when they felt that a future growth in earnings will give them an adequate return on their investment. Contrarily, if a company has zero or negative earnings, the P ratio will no longer make sense. It will appear as N/A for not applicable. Moving on, what if your prospective investment target is borrowing too much? This can increase fixed charges, reduce earnings available for dividends, and pose a risk to shareholders. The debt to equity or DE ratio measures how much a company is funding its operations using borrowed money, which is an external source of finance. It can indicate whether shareholder equity can cover all debts if needed. Investors often use it to compare the leverage used by different companies in the same industry. This can help them to determine which might be a lower risk investment. To calculate the debt to equity ratio, divide total liabilities by total shareholders' equity. Let's say that company X has $3.1 million worth of loans and the shareholders' equity of $13.3 million. If we do the calculations, the debt to equity ratio of this particular company is 0.23, which is acceptable under most circumstances. However, like all other ratios, the metric has to be analyzed in terms of the industry norms and company-specific requirements. Last but not least, we have return on equity, or ROE, which measures profitability and how effectively a company uses shareholder money to make a profit. For common stock shareholders, return on equity, which is expressed as a percentage, is calculated by taking net income, which is income less expenses and taxes, and dividing the result by total shareholders' equity, which is calculated by subtracting total liabilities from total assets of a particular company. Let's say that company X's net income is $1.3 million and its shareholders' equity is $8 million. Here, in this case, the return on equity is 16.25%. And in general, the higher the return on equity, the better the company is at generating profits using shareholder equity. And there you have it, a succinct explanation of the 6 of the most important ratios in the world of finance and investing. Hopefully, this video cleared it up for you at least a little bit. If you have any further questions, certainly feel free to ask them in the comments below. Additionally, if you liked the video, consider dropping a like, sharing and subscribing for more financial content. We are just getting started here and there is a plethora of exciting stuff coming. So thank you very much for watching and see you next time.